Welcome to An Alternate Hue. I'm Hugh Anderson, and this is some of what caught my attention this week. But before we get started, we're going old school. That's right, Walter Cronkite style. You see, the technology gods didn't like what I had to say this week in graphic form, as well as my compliance folks have tightened up my ability to move stuff around on computers because we certainly don't want the North Koreans to get a hold of it. So we have to go old school, so forgive me if this is a little different than the past. So that being said, as employers and landlords struggle with the post-COVID world, the in-office attendance trend appears to have settled on midweek. The people have spoken, and they don't like coming to the office on Manic Mondays, and TGIF is better from home. So Tuesday and Wednesday, 47% occupancy in offices, and Thursday has 44%. So quite frankly, if you want anything done, don't expect it to be done on Mondays or Fridays. But what's new? Last week's and today's well-received inflation numbers sent the stock market substantially higher and gave hope to investors that the worst was in for the cost of living. This next chart, which you will not see, but it's right here, will give you a feel for where the pain points are. And guess what? No surprises. It's airfare, food from home, and what surprised me is pet maintenance. Although the expectation is that inflation will come down over time, how long that will take is debatable. But what is most important is whether wages and incomes exceed inflation, even if it should return to much lower levels. Purchasing power is what matters at the end of the day. Now, Jason Trenert of Strategas Research discussed famed investor and investment consultant Charlie Ellis, who wrote a seminal paper on the money management business for the CFA Institute in the 1970s entitled The Loser's Game. In it, he made the observation that success in the money management business was a little bit like tennis, where the winner is often the player who makes the fewest mistakes and unforced errors. With this in mind, and with our conviction that monetary conditions will continue to get more restrictive, we believe the biggest unforced error as an investor can make today is to make long-term investments in companies that have come to rely on the kindness of strangers for capital. A year ago, it wouldn't have been difficult to IPO a ham sandwich, according to Trenert. Today, the liquidity window is closing and closing rather abruptly. Unfortunately, there are still a lot of companies trading at PE ratios with no E as in earnings. More than 45% of the companies in the Russell 2000 Growth Index have not earned a profit in the last 12 months. While some of these companies will undoubtedly wind up doing well, many more will find it difficult to survive in a period in which capital is difficult to access. Now, David Rosenberg analyzed the U.S.-China trade war and the resulting decoupling of the world's two largest economies. He asserts that it has been and continues to be bad news for the global economy. Diversification of production away from China because of tariffs, and also due to the post-COVID-19 pledge of multinationals to make supply chains more resilient, translates to lost efficiencies and higher prices, and therefore tighter central bank policies than would otherwise be the case. The trade war has also injected new animosity in foreign relations, pushing China to strengthen alliances with U.S. foes, thereby making the world a more dangerous place. Russia's war in Ukraine, with China's tacit support, is a case in point. While there will be investment opportunities associated with the relocation and diversification of supply chains to other countries, investors would do well to prepare portfolios for more challenging supply-side constraints than pre-trade war, slower economic growth, and more geopolitically driven volatility. You may not have an interest in politics, but politics always has an interest in you. Now, the night watchman who sleeps on the job has been skewered in movies and jokes for decades. But little did they know, there's money to be made in snoozing. That's right. If you like snoozing on the job, you can make $400,000 a year snoozing on TikTok. Jakey Bohm has more than 1 million online followers drawn to roughly the same storyline every night. At 10 p.m., the 28-year-old puts on PJs, climbs into bed, and tosses and turns to an international audience watching on TikTok Live. His monthly take from online fans, he said, averages $35,000 a month. If true, Pink Floyd had it right. We've amused ourselves to death. So that's it for this week. Stay stay healthy, stay happy, and optimistic. Better times are ahead, but most importantly, enjoy your holiday season.